All right, and the coronavirus outbreak continuing to wreak havoc on Wall Street. We saw record point drops today for all three major indices. I do want to bring in the head of macro strategy at Academy Securities, Peter Tchir, to talk more about the rout we're seeing there. Hi, Peter. Thanks so much for joining us today.
Thanks a lot for having me.
Markets falling into correction territory today, setting new point drop records. Why does something like this coronavirus outbreak have such a negative impact on Wall Street?
So, I think a couple weeks ago people were very complacent and not that concerned, and I think they weren't thinking about it right. It's not necessarily about how many people are getting sick or how many people are dying, though those are obviously important. I think the real fact is you've closed down about 700 million people in China from travel, and you're now starting to see that's the response everywhere a breakout occurs, right? You're seeing it in South Korea, you're seeing it in Italy, and it's this whole clamping down on travel. That's going to do a few things. One, it's going to impact supply chains. That's very important, but what I think people hadn't been thinking about enough until recently is it's really going to impact global tourism. China has become the largest consumer of foreign travel in the world. They travel more outside China than U.S. travels outside of the U.S. So with those tourists cut off, that's going to impact the global economy very quickly, and I think we're already feeling signs of that in the U.S. service industry.
Uncertain outbreaks like the coronavirus, of course, are expected to have a large impact on Wall Street. Investors don't like uncertainty. Another big headline accompanying the drop there, though, is falling Treasury yields. That drop is, of course, caused by a flee into the bond market, investors looking to buy some safer assets while we're facing this. Is there concern, though, that those falling yields will spark a recession, or is this a temporary impact?
I think right now falling yields have generally been a good thing for a lot of investors. And what I'm starting to see the past 2 days is what I'm calling shifting from what we call de-risking to degrossing. And what people have been doing right now is running portfolios where they own long-dated treasuries and they own equities. And those two things have been kind of balancing each other a little bit. And in the past week or so, the move in equities has been dwarfing that move that we're seeing in the treasury yield. So I think people are going to get forced to sell a little bit. And even in today's close, you watched equities sold off, but gold also sold off, and so did treasuries. So that's telling me that people are starting to reduce their risk. You're also seeing it in some other big trades. So tech underperformed Russell 2000 today. So I think you're just going to see people say, hey, this has become too uncertain. I have to shut down risk. I want to own a little bit more cash than otherwise. So I think that's why there's more selling to come in the days ahead.
And one headline swirling today is that now we're, approaching the biggest drop that we've seen since the 2008 financial crisis. I think one key difference, though, to highlight is, 2008 financial crisis that sparked the Great Recession. That was sparked by underlying bad economic data or bad economic figures here in the U.S. Here, though, right now, the underlying economy is still strong. Financial crisis, we're not in that same kind of situation, even though you're seeing this big drop in the market. This was expected, sparked by uncertainty, as you talked about. How quickly could we possibly see a comeback once more is known about the coronavirus?
I think we could get a solid bounce, but before we, give victory to the U.S. economy, there were a couple things that were already a little bit concerning. Boeing's been having trouble, and I think we often forget just how important Boeing is to the U.S. economy. So when you look at some of the Chicago PMI data, that was very weak, partly because of Boeing. Then last week we had, for the first time, services data coming from market partners was below 50. And the one thing we've been able to say for the last few years is every time we get any sort of weak manufacturing data, we can come back and say, well, we're really a service-driven economy. If services slows, I think this could get a little bit uglier than we expect. And unfortunately, I think we're not in the environment where politically anyone's really going to offer stimulus. I think both sides are going to be at such loggerheads that Europe might be able to get some stimulus. China might be able to get some stimulus. I think we're a little bit screwed if this gets bad. So I want to remain cautious. I would like to see this turn around. I'd like to see a big bounce. I think this is hitting at a really inopportune time given where we are politically.
We've got a big warning from Goldman Sachs today. They're saying that they don't see any corporate growth through all of 2020. Bank of America being a little more cautious on their warning, saying they do see an impact, but not a recession in the global economy. Then JP Chase saying that this could actually result in a hotter economy because of that stimulus that you mentioned globally. Where do you fall on the scale of that?
I think in the end, a year from now, we're going to look back and say this actually probably turned out to be a good thing for America and for a lot of other countries. We've already talked about, at least I've been talking about for quite a while, that people are pulling their supply chain out of China. It started with the tariffs and everything else, and I think there was too much dependence on China for many companies. And this situation where they can't get good clarity what's going on, you're going to see that supply chain pulled away from China. Some's going to come back here, some's going to go elsewhere. And one of our big themes has been that as the U.S. really wants to go at, I don't want to say at war with China, but there is that going to be economic, frustration with China. We're going to try and partner up with India, for example, much more. The president was just in India this week. There's talk about getting trade deals with India. So I think we're going to look and see a year from now that the world looks very different, and the dependency on China has been broken a little bit. So I think that's going to turn out to be good, but we're going to have some pain before then.
Quickly, before I let you go, you mentioned a trade. Of course, China and the U.S. did agree to a phase 1 trade deal that's seeming to be, of course, delayed because of the coronavirus outbreak. In the future, though, as we look toward talking about a phase 2 deal, if China's economy is totally wiped out by coronavirus, does that put the U.S. in a place of strength going into talks for a phase 2 deal?
Yeah, I think it would place us in a big position of strength. I think we are going to see companies start shifting supply back here, which is already good for us. And I think regardless of the outcome of the election, this view of China as a national security threat is real. So we're not going to go back to just letting Huawei, put equipment into place. So I think there's been a real shift in how we view China, and we are going to be, whoever's in charge, is going to be looking at this national security interest, and we are going to be tough on that, which I think is a big change from where we were 2 years ago.
All right, Peter Tchir, the head of macro strategy at Academy Securities, joining us to talk about the impact of the coronavirus outbreak on Wall Street. Thanks so much for coming on the show today, Peter.
Thanks a lot for having me.
Want to see more videos like this? Click on the link below and subscribe to One America News on YouTube, and call your cable provider and kindly demand that One America News is added to your lineup. Call and subscribe today.